They got caught. The $6 billion silver short just collapsed. But this is not a story about money. This is a story about a trap set by the most powerful institutions on Wall Street. A trap they were so confident in, they bet $6 billion it would never spring. It was a perfect plan, built on a single, unshakable belief. They controlled the game. They wrote the rules. They held all the cards. And they watched from their towers as the world played along. Until the day they didn't. Until the one variable they never calculated turned the trap against them. Welcome, everyone. Welcome to Wild East Stories. I am Marcus, a student of markets and history, living in the quiet mountains far from the noise of the trading floors. My work is not to predict the next boom, but to decipher the echoes of the last collapse, to understand how the pressure builds before it is released. Today, we examine one of those moments, a rupture in the financial fabric. But before we begin, if you are a person of experience, you understand that wisdom is not kept, it is shared. If this channel offers you a piece of that, consider subscribing. It is the quiet way you preserve a story for the next time it needs to be told. Tell me, where are you watching from today? The story begins not with a bang, but with a quiet, calculated decision made in a glass-walled office high above Manhattan. A group of traders, backed by a major institution, looked at the silver market and saw not a metal, but a machine they believed they could control. For years, silver had behaved predictably. Its price moved in a tight range. To these traders, this was not an accident of the market. It was the result of their own influence. By placing a massive short bet, a wager that the price of silver would fall, they weren't just predicting the future. They were trying to enforce it. Their bet was simple in theory: sell silver they did not own, hoping to buy it back later for less. The scale, however, was staggering. $6 billion. This position was so large it became a structural part of the market itself. It was a weight on the price, a self-fulfilling prophecy. They operated on a core belief. The paper world of contracts and derivatives they traded in was the real market. The physical silver, the bars, the coins, the industrial metal, was just a distant, irrelevant detail. They had the capital, the political connections, and the perceived rulebook. In their minds, they were not gamblers. They were architects. But in the shadows of their perfect trade, three silent faults began to form. Fault 1, the paper illusion. The traders sold millions of ounces of paper silver, promises of metal that did not physically exist. They believed these paper promises would never need to be fulfilled in bulk. Fault 2, the sleeping giant. Their enormous short position was not a secret. It was a glaring target on a public ledger. A community of ordinary investors, analysts, and industry users watched this giant, sleeping position. They started asking a dangerous question. What if everyone asked for their real silver at once? Fault 3, a changing world. Beyond the charts, the real world was shifting. Global industries needed more silver for solar panels and electronics. Mine supply was tight. A whisper of inflation began to stir. These were pressures the short sellers' models could not fully capture. The architects of the short bet monitored their screens from climate-controlled rooms, watching lines on a chart that told them they were in control. The price of silver remained docile, bending to the weight of their massive position. But the market is not a chart. It is an ecosystem, and in the trenches far from Wall Street, the first tremors of disequilibrium began as subtle, disconnected events. A Midwestern manufacturer of medical imaging devices found his usual supplier's warehouse unexpectedly bare. A 2-week delay on a routine silver coil order stretched into a month. His frantic calls were met with apologetic shrugs. The industrial pipeline was suddenly tight. At the same time, halfway across the world, a solar panel factory in Shanghai revised its annual procurement forecast upward by 15%. Their analysts weren't looking at commodity bets. They were looking at government mandates and booming installation targets. The silver was not for a speculative ledger. It was for a physical panel on a roof. These were not signals the architect's algorithms were built to prioritize. They filtered for hedge fund flows, options volatility, and macroeconomic data releases. The quiet, grinding demand from global industry was background noise. Yet, this noise began to manifest in a hard, cold reality. The premium for a physical 1,000-ounce bar of silver, the kind stored in vaults in London and New York, began to decisively detach from the spot price quoted on screens. The paper price, anchored by the short, stayed still. The physical price, pulled by silent, urgent hands, began to creep. This divergence was the first crack in the foundation, a sign that the paper realm and the physical world were decoupling. Meanwhile, in the digital forums and niche financial blogs, a different kind of pressure was building. A retired engineer in Florida, a dentist in Toronto, a shopkeeper in Munich. Individuals who had watched the 2008 financial crisis erode their trust began connecting dots. They shared regulatory filings, shipping data, and warehouse inventory reports. Their language wasn't the jargon of derivatives. It was the simpler logic of scarcity. If the short position was a promise to deliver silver that did not exist, and if industrial demand was absorbing more of what did exist, then a simple, inevitable question emerged. Where will the metal come from? This was not a coordinated attack. It was a distributed awakening. They began doing something radical in the modern financial system. They took delivery, not of paper contracts, but of the metal itself. 100 ounces here, 1,000 there. They paid the rising premium and moved the bars from exchange-approved vaults into private, secure storage. It was a silent run on a physical bank, conducted ounce by ounce, by people the architects never considered relevant players. Each bar that left the system was a grain of sand removed from the hourglass, making the short seller's promise to deliver that much harder and more expensive to keep. The institutions felt this pressure, but they diagnosed it as temporary noise, a sentiment blip, a technical anomaly. Their confidence was their armor. They had weathered storms before. Their response was not to retreat, but in some cases, to double down, adding to their short position to reinforce the price ceiling they believed was their right to maintain. It was a display of supreme hubris, a belief that their financial gravity could overwhelm the fundamental laws of supply and demand. They were pouring cement, believing they were fortifying a wall, not realizing they were steadily encasing their own feet. The pressure in the system was now a palpable hum, a vibration felt by those holding metal in their hands, yet still dismissed as silence by those who only listened to the digital echo of their own trade. A catalyst, in chemistry, is not the fuel. It is the agent that lowers the energy required for a reaction. For the $6 billion short, the fuel was the immense, coiled pressure of the physical squeeze. The catalyst was an unassuming report published by a small, specialized metals consultancy based in London, a firm whose subscribers were primarily mining engineers and procurement officers, not hedge fund managers. The report was a dry, data-dense analysis of global registered silver inventory. Registered inventory is the critical stock held in exchange vaults and available to settle the very paper contracts the short sellers relied upon. The report's key finding was not delivered with alarm, but with the sterile precision of an audit. It stated that over the preceding 90 days, registered silver inventories had fallen by 47%. This was not a prediction or an opinion. It was a simple, verifiable count. The vaults were being drained. The story of how this report moved from a niche industry bulletin to a detonator is a tale of modern information velocity. A junior analyst at a mid-sized pension fund in Amsterdam, tasked with a routine portfolio risk assessment, incorporated the data into a model. His model flagged a liquidity outlier event of extreme severity. He escalated it. His superior, remembering the lessons of a past nickel market squeeze, made a single, decisive phone call to their execution desk. The order was not to buy silver, but to exit a small, unrelated metals position and shift into ultra-liquid cash equivalents, a defensive crouch. But the desk talked. Word rippled through the tight-knit community of commodity traders in Rotterdam and London that a credible fund was getting nervous about physical metal delivery. Simultaneously, the data point was weaponized by the distributed community of retail analysts. Within hours, the stark figure, 47%, was stripped of its dry context and transformed into a blazing headline across financial forums and social media. It became a digital battle standard. The narrative crystallized instantly and disseminated globally. The cupboard is bare. The short sellers have promised to return borrowed silver that no longer sits in the vault. This convergence, the cold data from the consultancy, the defensive move by the institutional fund, and the explosive amplification by the digital crowd, created a moment of perfect, paralyzing clarity. The market's perception flipped. What was seen as a stable, if suppressed, paper market was suddenly revealed as a game of musical chairs where half the seats had been removed. The price of a futures contract was no longer just a financial abstraction. It was now viewed explicitly as a claim ticket for a physical asset that was in critically short supply. In the offices of the short-selling architects, the screens finally told a new story. The price line, for years a placid lake, developed a violent, vertical spike. This was not normal volatility. This was a structural failure. Their risk models, calibrated for a world of ample liquidity, began firing alerts coded red, demanding collateral, cash, to cover the exploding losses on their position. The phone calls began, not from opportunistic rivals, but from their own clearing banks and prime brokers. The voices on the other end were polite, procedural, and utterly merciless. They were margin calls. They were demands for enormous, immediate infusions of capital to keep the bet alive. The trap, which they had built to ensnare the market, had just closed around their own liquidity. The reaction they had deemed impossible was now inevitable. The only remaining question was who would move first to escape the ruin. The spark had found the fuel, and the reaction, once begun, could no longer be controlled. The most profound collapses in finance are not televised. There are no ringing bells, no shouts across a trading floor. They happen in the sterile quiet of a late-night conference call, in the hushed tone of a lawyer's advice, in the final, irrevocable click of a mouse executing a command no one wanted to give. For the lead institution behind the short, the margin call was not a request, it was a verdict. Their Treasury Department ran the numbers through every scenario. To meet the demand for cash, they would have to begin liquidating core holdings, blue-chip stocks, government bonds, prized assets. This would not only crystallize losses elsewhere, but send a devastating signal of distress to the entire market. It was an untenable solution. There was only one asset left on their balance sheet large enough to stem the immediate bleeding, the short position itself. They had to buy back the silver they had sold, and they had to do it now, in a market that now knew they were desperate. The first domino fell not with a public announcement, but as an anomalous surge in pre-market electronic trading. A cluster of massive buy orders materialized, methodically sweeping through every available offer on the screen. They were not trying to get a good price, they were trying to get any price. This was a forced liquidation, a buy-in executed by their prime broker to protect the clearinghouse itself. The effect was instantaneous and violent. The price spike of the previous day became a parabolic arc. Traders at other firms watched their terminals in disbelief. The algorithmic systems of rival banks, detecting the extreme price movement and surging volume, automatically shut down their own silver trading programs to avoid being caught in the unpredictable volatility. Within the hour, the contagion spread. Other institutions holding similar, though smaller, short positions faced their own margin calls. A frantic, panicked race began. It was no longer about profit or loss. It was about survival, about being the second to last to cover your position before the market ran out of sellers entirely. This self-reinforcing cycle, rising price, triggering margin calls, forcing buy orders, triggering higher prices, is the precise anatomy of a short squeeze. It is a financial feedback loop with the destructive power of a hurricane. In the physical market, chaos reigned. Industrial users, seeing their input costs skyrocket by the hour, flooded their brokers with orders, trying to lock in supply before it became unobtainable. This frantic real-world demand further drained the already perilously low registered inventories, tightening the noose on any remaining paper shorts. The disconnect between paper and physical became a chasm. The price on the screen became almost theoretical, a number reflecting a broken market, while the true cost of obtaining a bar of metal involved premiums that dwarfed the official quote. By the close of that fateful trading day, the financial landscape had been permanently scarred. The $6 billion bet had been unwound at a catastrophic loss. The losses were not just financial, they were reputational. The aura of invincibility that surrounded the architects had evaporated. Trust, the oxygen of the banking system, had been burned away in the fire of their own making. The collapse was complete. But in its silent wake, as the screens went dark and the exhausted traders went home, a deeper, more unsettling truth settled over the market. The rupture had revealed something far more significant than one firm's failure. It had exposed the brittle scaffolding of the entire modern financial system, where vast fortunes are built on promises that can vanish when met with the simple, unyielding demand for something real. The final act would not be a tally of losses, but a reckoning. In the days that followed, the market data told a sterile story of settlement. The price of silver, having touched a fever peak, retreated to a new, higher equilibrium. Volatility indices cooled from a boil to a simmer. The financial press published its postmortems, articles citing unprecedented volatility, a perfect storm of factors and lessons learned. Official statements from the involved institutions were masterclasses in anesthetized language, referring to de-risking activities and portfolio rebalancing. The surface of the water grew calm. But below, in the depths where power and structure reside, the tectonic plates had shifted. The reckoning was not a single event, but a slow, pervasive change in understanding. The first reckoning was epistemic. The fundamental models used to govern risk were now broken. The assumption that paper derivatives could perpetually decouple from physical reality was proven to be a catastrophic fallacy. Quants and risk officers across every major bank began a frantic, quiet review of all commodity-based positions, in copper, in oil, in nickel. They were no longer just looking at price charts and correlation matrices. They were now analyzing port throughput data, warehouse logistics reports, and manufacturing forecasts. The physical supply chain had been promoted from a peripheral footnote to a central risk factor. A new wariness entered the system. The confidence to place a multi-billion-dollar bet against the tangible world had evaporated. The second reckoning was social. The distributed crowd of retail investors, the dentists and engineers, did not walk away with the lion's share of the monetary spoils. That is not how these events conclude. Instead, they walked away with something potentially more powerful, a validated thesis. They had observed the structural weakness, applied pressure at a critical point, and witnessed the edifice crack. This proved that the market was not an omnipotent god governed by insiders, but a complex system with vulnerabilities. This knowledge is contagious and permanent. It seeds a future where such pressure can be applied again, more swiftly, in another corner of the over-leveraged system. The guardians of the old order now know they are being watched, not with awe, but with the analytical gaze of a challenger. The final, most profound reckoning is philosophical. The collapse served as a stark parable of a broader disease in modern capitalism, the triumph of financial engineering over productive capacity. The short bet was a meta-trade, a wager on the continued dominance of symbolic representation, paper contracts, over the underlying asset it purported to represent, silver metal. Its failure was a market-enforced correction, a brutal reminder that reality always imposes a settlement. For the business leaders and young entrepreneurs watching, the lesson transcends silver. It applies to any enterprise built on leverage, perception, and abstracted value while neglecting the foundational elements of logistics, supply, and tangible service. In the new silence after the storm, the signal is clear. Resilience is no longer found in complex derivatives, but in understanding the root of things, the source of the material, the loyalty of the customer, the strength of the balance sheet. The wealth historian would note that every great speculative mania ends not just with ruined fortunes, but with a generation's renewed, if grudging, respect for the ground beneath their feet. The $6 billion silver short did not just collapse. It became a monument, a silent warning etched into the market's memory, reminding all who pass that the price of ignoring reality is always, eventually, paid in full.